Morning, everyone. My name is Jeff Wilson. Thank you for coming along this morning. I was up a bit earlier, about 4:50. I didn't see anyone on the riding. Be careful of those people riding that have the Wilson Asset Management kit on. You're allowed to hit them, as long as it's not me. No, isn't it a beautiful morning? A little bit humid this morning, I thought. I don't know. Oh, cold. Okay. Maybe when you're cycling, it was a bit humid when we were cycling up the hills. But yeah, it's been a bit colder recently. Look, thanks very much for coming along today. There's a lot packed in today. This is our regional roadshow. Only because I spend a bit of time in Noosa, you get two of them. Yeah, everyone else gets the regional roadshow once a year. In Noosa, you get it twice a year because it's a good excuse. I'm up here for this week. I'm leaving back to Sydney on Saturday before the triathlon. So I don't know if that's it's probably a good strategy, is it? But I'll be back early December, so I'll see you then. In terms of sort of what I'd like to touch on, anyone who wanted to pick up a bag picked a bag up when they came in. You've got. And we're going to do something slightly different. In the bag, you've got, I think there's a pen, a little booklet, and then there's the green product disclosure statement. That's of the new fund, WAM, the Wilson Asset Management Leaders Fund, and that's a trust structure. Now, just on that, has anyone here invested in managed funds that are trust structures? If you can put your hand up. Yeah, okay. And I'd assume all the other people invest in listed companies or, because you're here, or listed investment companies. Is that a fair assessment? Yeah, okay, that's everyone else. I assume that. And there could be some friends of friends or... okay, no problem. And maybe I'll just talk about the trust for a second. Well, first of all, why are we doing it? The reason we're doing it is, well, if you go back 26 years ago, when I set up Wilson Asset Management, we actually started with a trust. So which we still manage today, and that's got about $70 million in. And really it was the trust, it's just a structure that pretty much most fund managers use. If you look at the fund management world, you look at fund management in Australia, it's about $50 billion as listed investment companies, which is about 1% of the market, a little over 1%. $150 billion is ETFs, which is a little over 3% of the market. And the other 96% of the market are the trust structures. And a lot of retail investors don't like trust structures because you get your statement at the end of the year, and it's not a simple statement. There's various levels. There's some capital gains tax. Some capital gains, some non-capital gains, and some franking, etc., etc. Where people investing in listed companies, you either get your dividend, it's either franked or it's not franked, or it's franked to a degree. So you know that. So our first trust was that, and we still manage, in that trust, we manage some money for FGX, and various other people that started with us 26 years ago. And we also manage some money for the Australian Olympic Committee on a pro bono basis. So we know the trust structure, but 18 months after I set up the business, I wanted to set up a listed investment company because I just like that structure. What I love about it is you can have a listed company that is effectively a portfolio of shares, and sometimes you know exactly what that's worth at all times, or broadly what it's worth, and there are various times where because things are negative, you can buy that, sort of $1 of assets at 80 cents, and there are times where that $1 of asset trades at $1.20. So that's one of the things I love about the listed investment company structure. And then obviously we've gone on to grow a number of them. And the reason why we've now set up a trust is because pretty much for the last 25 years, people have said, hey, look, will you do, when we've done another product, will you do that in a trust structure so we can get in at NTA and out at NTA? That's what all the people that like the trust structure love about it, in at NTA, out at NTA. The thing is, and a lot of people don't like listed investment companies because they can trade at discounts and premiums, and that's why I like listed investment companies, because they can trade at discounts and premiums. So anyway, what we decided with WAM Leaders, which invests in the top 200 companies, and we've had a lot of people, we set up WAM Leaders about 7 years ago. We've had a lot of people that wanted to, we had one Melbourne family that wanted to give us $30 million to manage in the same way as WAM Leaders. And another big group wanted to give us $50 million. And pretty much we've said, no, we won't. And then we wanted to grow WAM Leaders. And we've got it to a stage, like it's trading at a premium to NTA. It's 1.7 billion. It's a nice size. But in the area it plays, against all the other big fund managers, and they're managing 10 billion or 20 billion or 30 billion, investing in those large companies, we're a small player. In the medium and small size companies, we're a big player. And so what we decided is, hey, look, let's set up the trust. The first close was yesterday. It closes each month. If you want to put money in, if you're going to put money into the trust, then if you're going to do it, you do it just before the end of the month, because no use having it, you may as well have it in your bank account. And so it closes each month, and that'll continue to grow. And what it'll do for the WAM, it'll be invested exactly the same as WAM Leaders. Say if we have $100 million in each, and they bought $1 million worth of stock, then half would go to one and the other half would go to the other. So it'll be exactly the same. And I know the lady was reading the document, when I was sitting down there earlier, and in the document it says take a 5-year view, and someone said, oh, so in theory it'll take 5 years. And I said, no, it'll be exactly the same as WAM Leaders. Like, effectively we get the money today from the close in October. And it'll be invested exactly, if the WAM Leaders go, and we'll talk to Anna, WAM Leaders a little later, they got about 10%, they're underweight the banks. So, about 9.5% of the portfolio in the banks. So then 9.5% of, this new fund will be in the banks, like WAM Leaders. And the interesting thing is, since a few people said, oh, will that be negative for the listed investment company? Because now you've got another product. It's actually, and it was interesting, doing that survey. So, sort of, most people here aren't invested in trust structures. And that's what we're finding, that actually that you're either like that structure or you like the listed structure. And since we've sort of announced we were doing it back in August, it's now trading. We were at about, WAM Leaders was about a 4% premium, 4.4% premium when we sort of announced it. It was now sent out to everyone. And now the premium's more than doubled since that. So it's actually been positive for the listed investment, for WAM Leaders. Anyway, that's sort of, I just wanted to update you there. So that's that one. In terms of, and maybe we'll cover it, when we're talking to the guys in terms of view of the market, so I don't need to touch on that. Why don't I'll invite the other guys up to the stage now. So we've got Nick from the Global Fund Anna from Leaders, and Sean from Capital. Oh, sorry, from the mids and from the mid caps.
Everything else.
Yeah, everything else, exactly. Yeah. Capital, microcap, active, and research. And then after this, actually, do you guys know what the agenda is today? Pretty much, we'll do this panel. Then I'll sit with Dania for a little while, and then we've got another fund manager coming over. We'll talk about the future gen charities, and then we'll break for lunch. I think about 12 o'clock. And if also there's everyone you'll see on stage, but also Jesse Hamilton, our CFO, is here, and Will Deere. Anyone who's got one of these on, I'm wearing a tie actually. That's right. That's how you.
I don't have my badge, so yeah, tie's probably the best.
Yeah, ties or well.
It is me.
And Dania, you're meeting Anna now, and you'll meet Dania later. Okay, so look, why don't we start off? Why don't I start at that end? So Nick is a portfolio manager for WAM Global, and just try to. Here's probably a fair question. Is I wouldn't mind working on the big picture at some point, but why? Actually, no, I like to start on the big picture. So, what's your view, Nick, of the world?
Yes,
yeah, that's right. You got 2 minutes for that one.
So that's a very easy question, so allow me to begin. No, I was talking to a gentleman outside about that. So I think in terms of the WAM Global Fund, and I'm Nick Healy, so I'm the portfolio manager on the WAM Global Fund. The WAM Global Fund invests in international equities, as the name would suggest. In terms of the WAM Global Fund, we have been positioning the fund for a decent time now with the expectation that we would have kind of economic headwinds or the tougher economic conditions picking up just from the fact that interest rates have moved up around the world. I think what's been surprising in terms of the broader picture is just how resilient the markets, the economies have been to this point. They really have been very strong. I look internationally and the US has led the charge. However, we are starting to see some cracks appear. We are starting to see some companies find it difficult to operate in this environment. So we think we're well positioned for that because we put the portfolio in a stance of resilient growth. We think going forward, or we believe going forward, the companies that we hold are operating well. So we keep a close eye on how the actual companies are performing. And on an underlying basis, our companies have grown forward earnings by 7% this year, which is greater than the benchmark we're up against, the MSCI World, which has grown 3%. As long as our companies are performing well, it gives us a lot of optimism and confidence. And we stay really close to our companies, so we're always talking, having meetings with our investment companies. So that gives us a lot of confidence. However, we have seen an effect in the market where there has been a movement towards these mega cap companies that everybody's heard of, the Apples, the Teslas. I did this on Sunday, so it's a little out of date, but the S&P 500 is up 7% this year. Within that, the top 7 stocks are up 10%. So the rest, which is 493 companies, are down 3. And that's within large cap land, and then even more within small cap land, we're seeing a disconnect. So I guess to summarize, we think we're positioned for the environment. We are starting to see some cracks. Our stock price performance, we think, has faced the headwind of the fact we do invest in smaller companies than the market. But we're very confident just because they're operating well through this environment.
Yeah. And like we're sitting here in Australia, like why invest in global companies?
Yeah, so I think for me, there's 2 main reasons to invest internationally. The first is a company is not a company is not a company. There are 10,000 listed companies in international markets, over 10,000. But a lot of them just wouldn't meet the things we want to buy in a company. They might have poor balance sheets. They might be have poor industry positions. They just don't make the cut. But within that, there are just an abundance still of really good companies that can grow earnings over the next few years. And that kind of abundance of choice allows us to be really picky about what we choose to invest in. So we favour the things we're picky about are the quality of the company we invest in, the growth opportunities of that company and the price we pay, as well as always making sure we have a catalyst. And we just think it's companies that we hold, like I could give a few, but I can't go into detail on these, there's too many, but Intuit, Gallagher, Teledyne, Booz Allen. It's one of our large ones, but Visa is a fantastic business. These are the kind of companies that you can get exposure to in international markets. So just what's on offer. Yeah. And then the second one is simpler, diversification. So it is a very good and very important part of constructing an asset allocation because it provides risk management. And so this international investment opportunity is companies that have just wildly different drivers and geographic exposures. And having that exposure to different end markets, it gives real diversification to portfolios. So I'd say those two.
And then, Anna, what are we, I know we are with leaders, obviously you guys look at the macro, that's sort of a filter you use. What are you looking at the moment, or what drivers are you sort of looking out for, and what is the what does the uncertainty in the Middle East mean? Mm-hmm. Can we throw those in, or?
Definitely. Yeah. So we look at the macroeconomic environment as a starting point, because within the ASX 200 we have iron ore, we have the banks, we have every other kind of miner, we have infrastructure plays, and these are all being watched so closely by the consumers, the government, brokers, analysts and the like, that we need an edge. And a lot of these companies are driven by the macroeconomic environment, so that is why that is our starting point. To think about where we're going, we have to think about where we've come from, and the inflation problem that we've all experienced was really driven by government stimulus and central banks sending interest rates to zero for too long. Central banks are now working extremely hard to rewind this. As we've all seen, interest rates have increased at their fastest rate in 40 years. And that's really been in a bid to slow down demand, slow the economy and bring back inflation. As Nick said, the economy has been incredibly resilient. Everyone expected unemployment to be much higher than where it is today. We all expected retail sales to slow, we expected house prices to come off, and we haven't really seen that to a large degree at all. But we are starting to see signals that those savings that everyone built up during COVID have been worked through, and there is definitely pain points within the economy. The market has been quite shaky recently, mostly on this higher for longer rhetoric that's been put out by central banks that interest rates are going to be higher for a long period of time. We think over the next 3 to 6 months, the economy will continue to slow, and they'll continue to push the same rhetoric about rates. But at some point, the economy slows to a degree that they have to change. And as soon as they begin to imply that they're going to reduce interest rates, that'll be extremely positive for markets. We'll have earnings improving because the outlook for the economy will look better, and we'll also see valuations improving. So we don't think that we're there yet. At the moment, we're still quite defensively positioned, but over the next 3 to 6 months, definitely by the middle of next year is what we're anticipating, the environment will be quite different to what it is today. And that is our point of difference in our fund, because at the moment, the market is implying that there'll be no rate cuts until the end of 2024 or the start of 2025. So that is our point of difference. We're quite lucky in that we're very active, and because of how liquid our portfolio is, we can change our positioning quite dramatically over the course of a couple of days. In regards to the Middle East, for Australia, fortunately, there is very few direct impacts. The greatest impact would have to be on if there's an escalation continued pressure on the oil price, as often the price of oil spikes when it comes to any kind of conflict. And we did see this a couple of weeks ago when the crisis first broke out. So we are quite long oil. We have quite a big position in Santos and a small one in Woodside. And also gold, that's another one that in times of strife, investors go to safety. And gold, being such a physical store of wealth, does well in those time periods. So for us, it's been quite a tactical move of the portfolio. And there's also inflation implications if oil stays higher for longer and what that might mean to the rate story. But overall, quite a muted impact for you and I sitting here today.
And Sean, so you invest in the rest of the ASX. So is it 2,500?
Yep.
Listed companies?
Yep.
I know we keep losing. 2,800 is it?
Yep.
Okay. And so there's 200 in large cap, so there's 2,600. So, and you guys probably see 2,500 a year or something like that.
Between the four of us, yeah.
Yeah,
Nice.
yeah. So what are you seeing, and what do you think the outlook is for the more mid small cap sector?
Yeah, thanks, Jeff, and good morning, everyone. Great to be back in Noosa. Looking
Did you
forward
go
to
for
that.
a run this morning?
No, I was on the bike, actually.
Oh,
How many Ks do you get?
about 50.
Oh, I got 25. Yeah,
I got a lot more scenery. You're in the...
Yeah, I was stuck in the room just over there. Yeah, I guess from our perspective, I mean, the key thing to draw out is, it really has been a tough period for small cap companies. I mean, they've underperformed their large cap peers by about 30% over the last 18 months. So, looking at, I guess, valuations and sort of what's implied within that, I mean, we're seeing valuations at multi-decade lows. We've never seen such an extreme period of underperformance of small versus large cap companies in history. So, with the trajectory of those interest rate increases, investors within equities have really focused on maintaining liquidity within their portfolios. As a result of that, you've sort of seen that liquidity draw out of, the micro small cap sector. But I mean, clearly as a result of that, it's not all doom and gloom. There's a lot of negativity already priced in, and there's a lot of, blood on the streets within valuations at the moment. I mean, I was on a call with a US strategist this morning, and they were effectively pointing to over 60, I think it was 65% of companies in the NYSE are down over 30%. So that just goes to show sort of under the surface.
Over what period?
Over the last 12 months.
And what would the market have done over that 12 months?
Yeah, the market would be...
Well, I did the calendar year to date was up 7.
Yeah.
That's approaching 12 months. So
Yeah.
up.
Oh, okay, geez.
Yeah, so there's been a lot of damage done already at the smaller end of the market. So, whilst we think, I suppose, the next 6 months will be choppy and a bit volatile, like we're actually, looking further out, if you're willing to look sort of through that period, we're actually very optimistic around, I guess, the portfolio and how things position. So, that's sort of a summary of where we're at now.
Okay, now this is not in the script. So just a quick month. And we could have seen it, or it could have been last month. The bottom of the market.
When does the market bottom?
Yeah, which we're going to be wrong. Which we're all going to be wrong. We know that. Well, someone might be right.
Well, I should start because I think I have a bit of a look in here because you asked me that question last week as well.
I haven't asked these guys though. Yeah.
So, I'll go last. You're right.
Have you changed it?
Tip my hand.
No, have you changed
No, I'll stick to what I said.
Okay. Oh, well, ladies first.
If I had a crystal ball, I would say March next year.
Yep. Okay.
Catching falling knives, how fun.
Yeah.
I'm going to go February next year.
Oh, early. Okay.
Yeah.
Great.
I was the laggard. I said June.
Yeah. Anyway. So, which is interesting. So everyone's still a bit bearish. So
But it's all relative
the
too.
question
Yeah.
last week, I was waiting for someone on the panel to say, This month.
It's in.
This is
Yeah, we've just done it. Anyway.
For small caps, it could be in.
It could be.
Yeah, well, the important point is the market has gotten, at least in international markets, so top heavy that you could have portions of the market start to work well ahead of when the actual aggregate market bottoms.
Yes, because you've got the top 7 doing so much.
Exactly.
Outperforming. Yeah, so they could be falling
While
where the rest of the
others
market goes up.
Yeah.
Okay. I know we've got a lot of the various other questions for you guys, but what I'm going to do is, I looked at the time and we haven't really got that much time, have we?
We've got as much time as everyone needs, Jeff.
Yeah, no. Well, I know what I've been instructed for. What I wouldn't mind doing is just opening it up for questions on the floor now. And then I might actually, I might have a question on the floor and then I might throw a question up here. So any questions? See, geez, we mightn't get to me asking any questions. Yeah, thanks.
And what about the interest rate rise on Melbourne Cup Day?
Yeah, we're going to have an interest rate rise on Melbourne Cup Day? Yes or no?
So the futures,
yes or no? Oh, yeah.
I'd say yes.
Yeah, and what
I'd
are the
say that we
futures
are.
telling us?
They were about 20% chance of a rate rise before the CPI print last week. Since then, we have had an inflation print that was higher than expected, and we've had retail sales, which was stronger than expected.
What are they saying now?
So it's now about a 54% chance of a hike.
Yep.
In our view, it's not actually the worst thing if there's one more hike, because it really accelerates what we're already seeing in the economic slowdown. And if they do one more hike, it means they'll probably actually have to cut that much sooner.
Yeah. So
and then the narrative,
unfortunately, create a bit more pain in the real economy, which ends up being
less.
Yeah.
Yes. Michelle Bullock was very clear in a speech at the beginning of last week, saying that she was watching those 2 data points very closely to inform her decision.
And we
there's a proud history of central banks kind of taking.
Why don't we keep that down here, and we'll just go quickly around. So the lady in the middle, and then the gentleman in front. Oh, and I just see the green with the green top. Yeah, and then the gentleman in front, and then we'll go to the right. Yeah.
Your feeling about what's going to happen with this unrealised capital gains in superannuation, and can you lead a volley at the federal government like you did on
Franking
credits?
Yeah, and we'll try to do these answers quickly. On franking, which we've been punching them again, they've got some changes. We think we've actually got through a little bit, so we think we might have some. It might be positive. It hasn't gone through the Senate yet, and our conversations with various people on the know, I think there was. Is this being recorded? Oh, it is. Okay. I'll tell you later what they said. Okay, so that's that. So and with super, like because we're very focused on franking, we pretty much said, hey, look, we're not going to play the super game. When they came in and said it's unrealised, the following day, then we're happy to get involved. And we put a submission in, which we'll send, in the process, we'll send it out to all our shareholders. And yeah, to me, we actually had the solution for them in there. We think we know why they did what they did. Yeah, because they didn't announce it the first day, because it was only when they found out that the industry funds couldn't tell them the information, they said we're going to do it on unrealised capital gain, which is the second day. We think we've got a solution for them, and we will. We'll be pushing hard on that too. And the indexation, to me, that's crazy as well. But to me, the unrealised capital gain is the travesty. Yeah. And then over here we had a couple of questions, and then we'll go.
Yeah, good morning. I am a shareholder, the purpose of the question, I'm trying to learn from you, and the question is, what is your attitude to stop losses? Do you use them or don't you? Particularly, can you walk me through what your thought processes in I call it the COVID crash, February 2020, when you had some really brilliant companies just being wiped out or reduced in price.
So stop losses?
I guess I'll just start off on stop losses, and then other thoughts are probably very welcome. I think the challenge with a stop loss is today the market's increasingly, in my view, short term. We have a lot of these very short term managers pushing prices around aggressively. Sean kind of touched on this. Sometimes a stock price goes down and it's warranted, and you should actually sell at the lower price because the business is not conforming to your thesis and it's having issues. Sometimes it's merely just a short-term price change. They might have had a result, you've engaged with the company, you think the result's good, you think the company's doing well. That's a situation when we would be more adding to the position. So I think the challenge with a stop loss is companies hit those stop losses for two very different reasons, and it's the kind of like qualitative overlay that you have to put on that to really bring value. But I think there is information in price moving, so we're certainly pretty aware of it, but how we act on it is very different case by case.
Do you guys any comments on stop losses or?
Oh, I'd say for us, we don't use them at all. And it's really, our process is embedded in, identifying catalysts that we think can drive a re-rating in the share price. So we'll actively size our positions around those catalysts, and then, if the thesis changes, that's a potential sell trigger. But yeah, no use of stop losses for us. Yeah, stocks are on sale when they fall.
Yeah, but the tough thing is, that's right, they could be on more sale.
Correct. So
I mean, if we all knew, that's right, when the market's going to fall significantly. And the interesting thing is, we might sound a little bit bearish up here, but for those people that have sort of spent time looking at the market, there's sort of the old saying, time in the market rather than timing of the market. Here we're trying to, I sort of had a bit of fun and let's guess guess when the bottom is, but no one really knows, and we don't know where a top of a market is either. And what you tend to find is, Katrina, I think, I remember when she was, she worked with Nick on the Global Fund. She's based in New York, and when we were talking to her a little while ago, she was talking about this book she was reading. And I think the US market over time, over a 20-year period, had increased about 8% per annum. And if you weren't in the market for 20 days over that 20-year period, and if the 20 days were the best performing day each year for those 20 years, then your return was zero. You didn't lose money. So to me, it is interesting. So it tends to be. I know we prophesise, the market's going up, going down, but what we tend to learn is you're better off being in the market over time. And even though you get worried and you get excited, when it's up, you're better off riding it through.
And history and the patterns of the market can definitely serve as a good guide too. Like historically, what you've seen, when the market gets more confidence or visibility around bottoming and improvement in the economic cycle, like that's the time at which you'll see small caps and higher beta sectors of the market significantly outperform. So you're never going to time it perfectly, but
And you could be broadly, if you wanted to trade a bit, wanted some trading strategy. When you're feeling you're doing really well, then you probably start selling some.
Yep.
And when you feel as though, sort of like now, I don't know what's going to happen. Is the world going to blow up? The economy's going to get worse. They're going to increase interest rate. Then you probably want to be buying along those times.
Yeah, because that's the consensus view.
Just work against the consensus. Do we have another? Yes, thanks.
This is a quick question. This is a quick question for Anna. You mentioned gold. Could you point us to a couple of your highest conviction positions?
Definitely. So as of last Friday, we had Newmont trading on the ASX. It has acquired Newcrest Mining, so that's in place of Newcrest. We have Newmont, and with gold, we tend to trade it more based on the macroeconomic environment than the miners, so to speak. If anything, you don't want to own the miners when they come out with their production reports, because more often than not, they disappoint. So we tend to own Newmont now, as well as Northern Star, given these are the two most liquid names that we can move in and out of. But we do like gold as a thematic at the moment.
And from our perspective, like whilst we don't play a lot in resources in the capital fund, we really do look for ideas where we can see a catalyst to drive a re-rating. So Bellevue Gold's an example of a holding that we've had that's done quite well for us. And, it's really around, a really good management team in there, some nervousness in the market around are they able to get to, first gold and first production and drive that production run rate without, sort of straining the balance sheet. And to date, like they've been able to prove that out very well. And, that stock's up 70, 80%, I think, the last 6 months. So, yeah, that's the example of one that we like.
And you still like it?
Yep, we're still there.
And actually, while we're on stocks, why don't we just quickly do a stock each? Nick, do you want to start?
Yeah, absolutely. So I'll pick a stock that I think gives a little bit of a thought into how we try to approach what we want to own.
Actually, and here's the question.
Yep.
Because my father was a doctor and he loved the stock market. And in his later years, he used to do medicals, insurance medicals. And so he'd have when Western Mining was, I remember he said, I just saw the CEO of Western Mining. And he'd always ask them, should I buy their shares? and they would always say yes. And I said, but you're asking them the wrong question. Yeah. Tell them you've got $10,000 in the bank. What should you do with the $10,000? Okay, so we've all got $10,000 in the bank. What should we do with it?
Well, I can't give financial advice, but
no, this is general advice. Yeah.
Well, I was going to say,
recorded?
There's a certain.
Yeah, it is. Okay, so we can't give general advice. Let's go back to the other question then. Yeah, what's your favourite stock? One stock.
Okay, all right, great. So we hold Gallagher, who are the leading mid-market insurance brokerage firm in the world. Not to be confused with the CEO of Santos, same name. So what we like about Gallagher is, so we're talking to a lot of insurance carriers at the moment. I think Anna and Sean would have heard this as well, but the cost to insure is going up significantly. So primarily because of inflation, that is affecting insurers who are having to take their prices up, which I'm sure we've all experienced. But it's still quite challenging for them to make insurance economic and attractive. Gallagher as a broker really just gets the benefits of the price increases. They just stand in the middle and they connect insurance carriers with companies who require insurance. And even in these tighter markets, they're more beneficial to their customers because they can get discounts on insurance rates, they can tailor solutions. So we think great industry, really well positioned right now because we think insurance is very firm and set to remain firm. Management is so critical to us, and the management of the company run by Pat Gallagher, again, not to be confused. They've just done an exceptional job over the last few years. So we really think we're invested with good people. And importantly, catalysts. They had an investor day in September. We saw upside to numbers all the way through next year. They had their result last Friday, and like we expected, they beat expectations. But we still think there is still upside to numbers through 2024. Valuation's attractive, so it ticks all the things we like to hold.
Great. Okay. Anna, what about?
We're quite excited about Goodman Group at the moment. The ticker is GMG. I'm sure quite a lot of you know it as a logistics real estate play, and it has been a market darling for the last 5 years, just capitalising on this e-commerce boom and the requirements for warehousing and infill locations close to the city. And Goodman Group owns the best locations globally that are strategic, near cities, near airports, and they can charge rents well above their peers. And that's been a fantastic story. But in August, the story got even better because they announced that they are moving in a direction towards data centres. Now, I'm sure all of you have heard of AI and the increasing data requirements globally, and that needs to be captured through these data centres. The issue with data centres globally is that firstly, they need to be in really good locations, again, close to cities with electricity that can support the infrastructure. And also funding is difficult because they need to be built before they have the pre-commits, before they sign up the Amazon Web Services and the like. So Goodman has resolves for both of these problems. They have the capital and they already have the land bank. We've always liked the data centre story, but valuations can be a little bit challenging. When we look at Goodman as trading now, given the recent macroeconomic turmoil over the last few weeks, it's trading back below when they announced the strategy in August. So we think at the moment is a really good opportunity for us to increase our weight, and that's what we have done.
Sean?
As a believer in diversification, I'll take a slightly different angle and I'll go for a few key themes that that we like in the small cap space. So I guess to start with, the housing and construction materials area is a space that we particularly like. I guess within that, Boral is one that we think has a really strong outlook from here, led by Vic Bansal, who obviously had a lot of success with Cleanaway. The infrastructure investment that's going into Australia over the next 10 years will be significant, and we think they will benefit very strongly from that. Mars Group's another one we like. That's basically a vertically integrated construction materials company. So they're going all the way from the quarry through to the residential lots to drive pull through. Valuation screening attractive. Their management own 50% of the company, so there's strong alignment. We like, the consumer retail space has been absolutely smashed. And, for that reason, to us, there's a few really interesting names within there. So Nick Scarley and Premier Investments would be the two that we like in that space. And it's particularly around the balance sheet, I guess, providing significant optionality for those businesses to capitalise on the bottom of the cycle. On to Anna's point, within the tech space, we like the profitable ones. So on the AI theme, NextDC and Megaport are two that we've played that through. I was in the US back in June, sort of when that was all taking off, and called back to the office and said to the boys, we need to buy as many of these two as possible, just given the structural boom in demand that you're going to see over the next 5 years for computing power and capacity. And then finally, we like the oil and gas and I guess the broader resource services players. So, the likes of Monadelphous that we think is going to really benefit from a boom in, I guess, the major iron ore players shifting from what's been typically sustaining capex back into growth capex in order to sustain those iron ore production rates. So we think there's a lot of investment to go into the Pilbara. And then also Worley Parsons, which is benefiting both from, I guess, the renaissance of investment in oil and gas and traditional, sort of fossil fuels, but then also has a foot in the other camp in terms of assisting that energy transition around, wind and solar and nuclear and whatnot. So, that's probably a few sort of key themes and stocks that we like. But of course, happy to chat anything after the presentation.
Okay, excellent. No, thanks, Sean. And my one is Global Data Centres, GDC, and it's pretty much picking up on your theme, data centres, but they had it in a listed structure and it just didn't get properly rated by the market. So the management have said, hey, look, we're going to give up, we're going to sell all the assets and give the money back to shareholders. So it's trading a little over $2. We think you'll get between $2.50 and $3. So that's a simpler play. We've got time for a couple more questions before before Danya comes up and we have another panel. So any more? Sorry, there's a question, at the front there. And then one on the left there. Yep, thanks.
My question is around about discount to premium on NTA. Global has been predominantly discounted for a long, long time. The others have been probably premium to NTA. Can you just comment on the reasons why and what sort of effect that has to investors, please?
Yeah, what an investor, if you're like sort of Warren Buffett used to say, if you're if you have a hamburger, Betty's Burgers, hypothetically, if you're making hamburgers, what do you want hamburger meat to go up in price or do you want it to go down in price? and in theory you want it to go down in price. So if you're still want to invest, then you want the discount to get bigger and bigger because you want it to be cheaper and cheaper. It's only when you want to sell that you want it trading at NTA, if not a premium. So that's sort of the scenario. But in terms of why do they trade at premiums and discounts, it is as simple as supply and demand. And if you look at, WAM, say, let's look at WAM Global, floated, there was good demand, did trade at around NTA, a little bit of a premium in the early days, went to a discount. Now, why did it go to a discount then? It's because when you raise money from people, they all have different levels of expectation. And some of them may believe you're meeting those expectations. Some may believe you're exceeding those expectations. Anyone who believes you're not meeting the expectations ends up selling. So what you tend to do is you find a number of, like 25% of the people you raise money for end up selling in the first few years. So there's a chance that listed investment companies go to discounts through those early years. And with WAM Global, and then it went back, and we effectively got back to NTA. And how does it get back to NTA? I mean, that's why we're here. Because you need performance, you need yield, you need the company to treat shareholders with respect, and that's all listed companies should do that. And the fourth thing you need for a listed investment company is a really a structured marketing, shareholder engagement strategy. And we've got, we spend probably $3 to $4 million a year on that, and that's a cost to the manager. And that's in theory because what we want them all, the entities to do to trade at NTA, if not a premium. Then with WAM Global particularly, an opportunity came along to merge with Templeton Global, and that effectively doubled the size. So it took it from a $450 million company to just under $1 billion. Now, what was the logic for getting bigger? What you tend to find in the listed investment company space, a lot of the drivers, the buyers of the listed investment companies are the financial planners, and they want liquidity. So you tend to find that the bigger you are, the easier it is to trade at NTA, if not a premium. And an example of that is, when Soul Pattinson's bid for Milton a little while ago, it was just they were an investment company buying another, an LIC, and you'd assume there's no synergistic benefits. Nothing should happen to the share prices of both companies. Soul Pattinson, the share price went up 20%. And that was just purely people saying, hey, this is going to be more liquid, and they're prepared to pay up. So that was the logic for the merger, so that was very sound. What we're dealing with at the moment is when the board did the deal, you could get shares or you could get cash. And you got cash at about a 6% lower than the value of the shares. So pretty much everyone took shares. And then broadly, everyone took shares, and they've been sort of they've been selling. And so WAM Global is just in the process of sort of effectively tightening up. I use the phrase tightening up its shareholder base. Now, it was trading at a 20% plus discount. I think it's about a 13 or 14% discount at the moment. So it's moving in the right direction. And we will get it back to NTA. Was at a discount as well. And that was because of expectations. Like when we floated in the first couple of weeks, there were a couple of takeovers or a couple of liquidity events. Then everyone was expecting them to happen every day. And then it went to a 10% premium, and everyone who bought it up there ended up selling it, I'd assume, because when you're buying $1 of assets for 80 cents that WAR does, it takes time for that 80 cents to turn into $1. So yeah, it's not an alignment of expectations, and all listed investment companies are. It's just a function of supply and demand. And why do they trade at premiums? Well, yeah, the longest one it took us to get to NTA was WAM Research. It took us 7 years. It traded at a premium in the early days, then it took us 7 years. And unfortunately, we did too good a job there because we'd really tightened up the share register, and it actually got to a 58% premium to NTA at one stage, which is ridiculous as a big discount. So does that sort of answer your question? Yeah. So to me, I'm confident that that WAR, WAM Global, and WAM Alternates, which is the old Blue Sky one, which you'll hear from Dania in a second, and maybe I'll talk about that. Why we think we'll get that back to NTA. But they're the three that are trading at discounts. Last question. Sorry, we've got that question. Sorry, second last question over there, and then last question over there. Yes, thanks.
Thanks for the opportunity.
Yeah.
That's the first thing to say. And my question relates around the current value of the Australian dollar. I mean, the benefits of investing globally are very attractive, but there's a bit of hesitancy for the mum and dad investor at the moment looking at the value of the Australian dollar and realising that at some point that'll correct and perhaps wipe out a huge amount of capital gain. So I'm just wondering how you would advise us to approach that and how you approach that with your investments, please.
Yeah, I think that's a great question. The way I agree with your thought entirely in that if you look at the Australian dollar through time, there are points in time when it gets so disconnected that you then start to think probably it's going to be a headwind going forward. I don't know if I'm in that world yet because, and correct me if you have different views, but the Australian dollar tends to be quite pro-cyclical. So if we are going into a slight slowdown or if something's happening, it would be hard to say we are there right now. Currencies in general, I feel like are just part of the diversification benefits of international companies. So the US dollar has very different dynamics to the Canadian dollar, which is very, resource-based. Euro has its own thing going on. So having the unhedged approach is probably our base preference because it unlocks the diversification in its full entirety without kind of hiving away a portion of it. The only caveat to that is I fully agree that at certain points in the cycle, the Aussie dollar looks bombed out. So that would be a thought we would certainly keep in mind. But I don't think it's, for me, subject to being wrong, I don't think it's today, but agree. Does that answer your question?
Yeah, I'm just wondering, therefore, how do we approach that? Because my feeling is it's going to be revert at some point in the next start to the next 12 to 18 months. And at that point, that investor, you're going to get your pants down if you put your money in now, and 30%, gradually increase over time, and the Aussie dollar is going to wipe out a lot of capital gain.
Yeah, and the question is, because I know this is being recorded, so the question is, okay, what happens when the Aussie dollar mean reverts? I said it, now it's low 60s against the US. Say if it goes back to 80, then I'm down 20%.
One thing to keep in mind is the US dollar has been all-conquering of late.
Yeah.
So there are a lot of currencies in the world. I wouldn't just do the Aussie-US pair. Euro's been soft. Yen.
Hey, I was in London. London in June. It felt bloody expensive over there.
Yeah.
To be fair, I was in Europe in September and it did feel bloody expensive. No, look, I think to your point, that would be a headwind to performance because we translate it back to Australian dollars. So your thinking is correct. Yeah. We historically like the benefits of the international currencies. If we did get to a point where we thought it was extremely disconnected, we do have the freedom to hedge currencies. But we would disclose that in our communications.
And we haven't.
And we haven't.
And in theory, because we're saying, look, you guys, this is what you've got. It's a lot clearer. And Wayne, thank you. Oh, we just get the,
Thanks, Jeff, and thanks for bringing the team up to Noosa for us. Much appreciated.
It's not hard.
Not hard for you, but the rest of the team come a long way. Just like you to comment on some of the former top performers or outperformers in the Australian market, like CSL, ResMed, even Macquarie Bank lately, that have fallen out of favour and in fact dramatically underperformed, especially CSL. Do you think they're close to bottoming now after a rough patch? and is there value there? And then on the other side of the coin, those ones that are still hanging in there, like REA Group, Xero maybe, are they likely to see the same thing where they just get their valuation gets too far ahead of themselves, and despite the quality of those businesses, then you go through 3 or 4 years of underperformance? So we've sort of got a changing of the guard happening. So if you could just comment on those sort of two groups. Thank you.
Definitely. I think it's a really great question, and it all comes down to expectations. All of those companies that you just called out have previously, if not currently, been trading at quite high valuations. Therefore, they don't have much room for error at all. So whenever they are below expectations, the share price is impacted much more than a company that is valued cheaply, for example. Firstly, on CSL, I agree with your point. Has it nearly bottomed? We think so. We have been, over the last fortnight, building quite a large position in CSL, trading below 250. I think it definitely screens as value. Sentiment has turned quite negative on it, and it was such a market darling, so the contrast from that to where it is currently has been quite stark. But you understand why. Each of their divisions, firstly CSL Behring, which is their blood plasma division, is at the threat of FcRNs, which is a kind of new age drug that might wipe out a proportion of their revenues. We've recently had some phase 3 data readouts that have looked quite positive, so there's been concerns around that. The Seqirus business, which is their flu vaccine business, is threatened by mRNA vaccines. And lastly, their V4 business, which was recently acquired, recently, probably 18 months ago now, the transaction completed, is a blood iron franchise, and their European business has come off patent. And now when a drug comes off patent, not only does the price decline dramatically as competitors enter the market, but they will sell less because there are now competitors in the market. So there's been concerns about each division, but I feel like they are extremely well known. I met with management last week and we walked through every concern that I had, and it felt like there was nothing new, no new information. It's discussed to the death in all sorts of analyst meetings and broker meetings, and that there's actually quite a few upside drivers, be it yield initiatives. They're past their CapEx, so capital expenditure hump, so we expect returns on invested capital to improve dramatically over the coming year. Margins are expanding, demand is improving where it was previously quite weak during COVID. So there are a lot of tailwinds, and I think they've been discounted entirely. I think where it's currently trading is good value. ResMed is similar. It has been destroyed by this GLP-1 weight loss drug thematic. There are concerns that it is going to completely wipe out their business model. But again, sentiment has turned so negative on it, it's halved. And do we think the threat of GLP-1s is that great? No. We had this a decade ago when bariatric surgery came into fashion, and ResMed has just continued to grow through the cycle since then. So we've also built a position in ResMed recently. We also think healthcare in general is a good place to hide, so it's actually quite a good opportunity to increase weights in these names. Macquarie Group, we'll try to wrap it up, is quite cyclical. They are exposed to obviously their funds under management, so naturally a hit when the market declines. They also have capital markets business, and there's been very few IPOs and capital transactions recently. So the outlook is quite weak, but again, it's one of these names that Sean talks to that when things begin to recover, it'll be one of the first to go. So it's looking quite interesting, particularly when we compare it to the big four banks, which is really the trade-off we have to make, and we aren't very positive on the outlook for the big four banks at the moment.
And just touching quickly on REA, realestate.com, we've got exposure there through News Corp, which owns 60% of the business. I mean, I personally think it's the best business on the ASX. I mean, it's bottom of the cycle, or we're just coming through what looks to be the bottom of the cycle in the housing market, and they've just raised their prices by 15%, and they had 3 out of 2,500 customers cancel. So that's a reflection of how good of a business that really is. And then I suppose if you look at it from going here, I mean, you've got Australian house prices up, 10% calendar year to date. Listing volumes are really starting to ramp up. So yeah, we actually think realestate.com looks good value here.
Look, thank you. Thanks. Look, thanks, Anna, Nick, Sean. Thank you very much for your comments. And now we'll just, thank you. Hi guys, and I'd like to introduce Dania, who runs the WAM Alternate Asset, is the portfolio manager for WAM Alternate Assets. And let's take a step back. How long have we been managing WAM Alternate?
3 years.
So actually, it started 5 years ago. I think our journey into alternate assets, and what happened was, you had Blue Sky, which had a listed vehicle. The management company was listed, which ended up going under, and it had a listed investment company that had some really good, interesting assets in it. One of them was the Argyle Water Fund. And an opportunity, I saw an opportunity that we could become the manager of that. And because personally, I just like the idea, through my life, I've tended to invest in equities. I tend to have cash, or actually I roll 90-day bank bills, or I invest in the equity market. And then I like the idea of having the opportunity to invest in an alternate asset, in alternate assets, and that's. And then we thought, like, what a great opportunity, because it's the only one listed on the stock exchange. Back in its heyday, it used to trade at a premium to NTA. Just sort of coming back to this gentleman's question over here, and obviously Blue Sky, the management company blew up. And then we took over. We ended up taking over the management of the listed investment company. Now the assets in there, they were hard assets, so we took over the management of it. So it was nothing to do with the operating business, Blue Sky. But through that process, all the negative sentiment, then there was a lot of selling, and the company ended up trading. Well, when we ended up starting to manage it, I think it was it was it was trading at a 35% discount to NTA. So then became the journey for us to get it to NTA. And how do you do that? Well, you do a good job managing the assets, which is where Dania comes in, and then you need to communicate to people, clearly, the value of the assets we've got, what we're doing with it. And the interesting thing is, so you had to convince all the people that were in there that the assets were worth what they're worth, and then get new people to buy the shares of the people selling that had decided, hey, look, I just want to get out, I've had enough. And in that process, it's interesting, when you're trading at a 35% discount, like Dania's done an incredible job, A, managing the portfolio, but B, communicating with the largest shareholders. But what you find is, when you're at such a big discount, like, people will buy the shares at a 35% discount and they'll sell it at a 30% discount. And then another group will buy it at a 30% discount and they'll sell it at 25, so you actually get a lot of people that will trade the discount. So it's not as if you just need to buy the people selling at the 35% discount. You've got to, there's a lot of liquidity that, runs around the system. And now, what discount is it? Is it down to about
13%?
Yeah, 13%. Discount. I know before the market had the jitters.
Yeah, we were at about 6% discount.
Yeah, we were getting a lot closer to NTA. And I'm very convinced that WAM Alts will trade at NTA, if not a premium over time. So that's my sort of my involvement. And I own, was it 7 million shares or something like that? So I'm along for the ride. Or one of the largest shareholders, yeah. So what do you do you want to explain to people, like, why invest in this in WMA?
Yeah, no, thank you, Jeff. Thank you for the introduction. And as Jeff alluded, it remains a unique proposition to the Australian retail investors, because when you look at available options that are easily accessible in a liquid way in alternative asset classes, that's the only one that gives access to a portfolio that is diversified across all those asset classes. As you saw in the video, we invest in privately owned businesses, privately owned assets across infrastructure, private equity, real estate, real assets. So we're Noosa. We talked yesterday evening with Jeff, Betty's Burgers. I'm sure some of you would know them. Founded, that was their first shop in 2014, founded in Noosa by David Hales. That's the guy that you wanted to remember his name. And the business grew up significantly, so they now have 54 stores across Australia. And we have investment in their mothership company, Retail Zoo. So we have exposure to Betty's Burgers, Boost Juice. Boost Juice is very popular in Queensland as well. These are the type of private equity investments we make. In infrastructure, we have investment in Sunshine Coast Airport, really well performing. I just checked their numbers yesterday, 28% growth in passenger numbers, revenues is growing strongly, so regional airports do perform quite well in Australia. And these are the businesses and assets that most of the time retail investors, they cannot just go and buy themselves. So for me, it's about finding those opportunities, good quality opportunities, and bringing them to our shareholders via this structure that most of you understand well and know well, the listed investment company.
Perfect. No, thank you, Dania. And like you mentioned a few examples. Do you just want to give us a bit of an overview? So I buy shares in WMA. Now, first of all, I'm buying them at a discount, which is tick. In my purchasing world. There's a profit reserve which you can look at the monthly NTAs and it's paying a dividend. So they're a couple of positives. But in terms of I'm investing assets that aren't listed on the stock market that you can get access to. Do you want to give me a bit of a big picture view of what's in there? I know the water fund used to be a big percentage. Yeah. Now we've reduced it.
Yeah, we've reduced it a bit. Yeah. So I'll start with the profit reserve. Before going into the overview of the portfolio. When we started managing WMA, profit reserve was, I think, 2 cents.
Well, I didn't have much. I know we're looking sort of, I remember when we took it over, it's sort of like you're looking over the abyss. You're thinking, how can we pay a dividend? We've only got 2 cents in this reserve. So our best case scenario is we're paying 2 cents dividends for the rest of our lives. Yeah. Just once. Yeah.
So that's now at about 18.5%.
18.5 cents.
Yeah. So cents, and the dividend increased to 4.8 annual dividend, and it's about 6.8 fully franked. So that's been a good progress. The board did take a view that as profit reserve grows, gradually dividends will grow as well, which I know is very important for our shareholders. In terms of the portfolio, alternatives often trigger this reaction that, this is just too risky for me, too complex to understand. The reality is that within alternatives, there are strategies and assets that are lower risk, lower returns, and they have more focus on producing fairly predictable, stable income returns. So core infrastructure assets, most of the time they have long-term contractual revenues in place. Those revenues are often linked to inflation, which means the income return that we're receiving from those assets, they increase together with inflation every year. In the current environment, it's a positive story. I like the story about investing in the theme of growing demand for food, because we eat every day, we do grocery shopping every day, population keeps growing, and the question to you, if anyone knows how much we spend now monthly on grocery shopping, just roughly, any guess?
Oh, it's a question. Okay. $500. $500.
So it's close. So it's about.
Jeez, this sounds like a politician. You know, nearly. You ask Albo, how much is a pint of milk?
When
no,
you put
he doesn't.
Like we all know, it's inflationary environment, but when you put the numbers, it's shocking. It's shocking to see where food and non-alcoholic beverages inflation has got to. And it's about $770 a month on grocery shopping that Australians spend on average now.
Gee.
Now,
far out.
This number alone doesn't mean much. It's a 60% increase on last year. Gee. 60% increase.
No one? God.
So to me, when I look at those factors, I don't act on them immediately, right? Because these are very different assets, different investments. But for me, that means where I focus the efforts, what I want to have in the portfolio. So within WMA, it's about 24% exposure to real assets. Real assets such as water entitlements, agriculture assets, agri-related businesses. They have this embedded inflation protection in their investment returns. And if I see this level of food, non-alcoholic beverages inflation, I do want to have access to those themes. You saw we have 400 hectares American citrus farm in the portfolio. It's a really good quality asset in very well irrigated region in Australia.
And you were down there the other day?
Yes, we went to see the asset a few weeks ago. And then themes like healthcare, they're really important ones. So again, breaking down income and growth. Income, I'm talking about investments that would produce 5% to 7% annual income return. On top of that, you can expect some capital growth, but it's quite moderate. Predominantly for me, it's about income from these assets. And so within healthcare, we have investments in healthcare real estate, excellent assets, some really large, well-established hospitals, like Gosford Private Hospital is one of the largest in Australia. The type of leases that operators have on those assets, they can range from 10 to 50 years. And again, they are all linked to inflation, which means income return will be increasing together with inflation. On the other hand,
they just charge us more.
They just, well,
when you go to the hospital, you just get charged more. It's not as if
unfortunately, that does translate into increasing healthcare costs. Yeah. But we just saw the ones who read AFR. There was an article today about potentially one private equity deal happening soon. So if that happens, we would have it in our portfolio as well. We invest with an investment partner called Crescent Capital, and they're one of the best investment teams to access healthcare businesses within the private capital space. So they've done lots of deals in clinical trials, medical, like GP clinics and other services. And there is a lot of demand and very limited supply for this type of businesses. So great growth opportunity for us. Anna talked about industrial logistics, how you can access it through listed investment or listed companies or through equities. We have this exposure within WMA as well, where we acquire plots of lands, Sydney, Brisbane, Melbourne, and then develop last mile logistics assets. So it's a great growth strategy within the portfolio.
And probably what not everyone knows is before Dania joined us, her experience has been in this alternate asset space for a couple of decades, and so a lot of these the other our sort of investment partners, Dania actually helped set them up. So so to me, it's a great opportunity for us to have done managing this money on our behalf. Now, in terms of when I was giving a bit of the introduction, talking about Blue Sky, the first thing I think is, well, what did you do with all the stuff Blue Sky had? And so when you took over managing the portfolio 3 years ago, how much of it did you end up exiting? So where are we now with, say you had 100%?
The portfolio has been going through changes. It's inevitable. It's a life portfolio. So
and as you find better opportunities and remove whatever you didn't want in the portfolio that didn't work with
you call it remove, I call it exit. So,
exit. Okay.
But means exactly the same, right? So 11 assets, 11 investments have been exited over that period of time. Exits have been really strong and delivered really good results. So out of this 11 exits, 8 exits were achieved at premium to carrying value. Which again, without going into the details.
Premium to what they're in our
to what we were holding them at. And I know there are always a lot of questions on valuations and valuation practices in alternative assets. To me, it's all about the track record and investment performance. Like once you can demonstrate that you can sell those investments and assets at premium to what you hold them, that is a good indicator of the disciplined valuation practices in the portfolio. And at the same time, the capital that we received from those exits, from those sales, was reinvested in new opportunities. So new asset classes that we added, infrastructure, we invested in private debt. I know last year there were quite a few questions on private debt. Now we invest only in senior loans. These are loans to well-established cash-generative businesses in Australia. And again, from my perspective as a portfolio manager, it's a great way to add some interest rate protection because they are all floating, which means when RBA, if they announce the interest rate rise to, I don't know, the sentiment is probably to 4.6%, we'll see. That means our income return will also increase from this type of strategies. And we have about 25% of the portfolio still in those inherited assets. So over the next 12 to 18 months, we'll continue looking for opportunities to sell and exit them. This year has been slower because that's what we call buyer's market. So there were more opportunities to invest. But because where the market has been in terms of the valuations, we've been much slower in terms of selling the assets. But I expect next year the picture will change.
Great. Why don't we open up for any questions here? We've got Jesse and yes, we've got one there.
Thank you. Thank you. It's my impression that your cash position has stayed pretty much around 35%. Is that your center point? You buy something, you sell something, your cash position changes. What kind of cash position do you try to shoot for as on hand?
Yeah, no, great question. So what you'd see in the NTA report, the cash position, that would include committed and uncommitted cash. So uncommitted cash, in my mind, is the pure cash basically available for new investments. Committed cash, which is 80% of that, over 30% cash, has been already committed. Now, the way it works in alternative assets, if I commit to a new investment, it doesn't mean that capital is taken and invested the next day. It does take sometimes 12, sometimes 18 months to deploy this capital. So last year, it's been slower on new investments, but pretty good year for exits. So we've been doing a lot of exits and accumulating more cash. But at the same time, I've been committing it This year, we've been much faster on the capital deployment front, and I expect by the end of the year, that level of committed cash will reduce. Long term, I'd say 14, 15% is a good level for this type of the portfolio.
Yeah, and just on that, in terms of the cash, it's in the bank or in TD?
Yes,
getting 4.25,
yes,
or depending on what the TDs are, 5 and a bit.
We do try to,
Maximise.
use, fairly secure instruments to minimize the cash drag on the portfolio. Yeah.
And any other questions? Yep. Thanks.
Dania, one of the key things that attracts me to this portfolio is your level of volatility. And I see it as a great diversifier because your volatility is about 7.5%, is that right?
It's actually 3.4%.
3.4%. Well,
yeah,
there you go. What a great selling point.
Thank you.
Well, and for people that don't understand it, so the equity market, what's the equity market about?
14.5%.
Yeah, 14.5% volatility. So you'd assume if something gives you half the volatility, then you'd assume it would give you half the return. So
yes, so it's actually we did this really good analysis looking at the measure of risk, i.e. volatility, and the investment return over the period of 3 years. So per annum, if we compare WMA investment return to ASX All Ords, the investment return is on par. It's just above 10%. Volatility for WMA, 3.4%. For the ASX All Ords, 14.5%. So this is where, when we talk about complementary benefits, diversification benefits, that's a great point for investors and planners when they look at adding alternatives to the broader portfolios.
But that wasn't your question, sorry. Or was that your question?
Well, it helps.
Yeah.
It makes it attractive against in a shared portfolio to have something with such low volatility and reliable returns, reliable dividend, basically. And so that's really fine. Yet most people could be frightened of this word alternative.
Yeah.
That it's in the private markets.
Yeah.
And but it isn't like that because it's 3.4%. What's happened to the NTA since you've been?
NTA has been growing, so it's now at 1.21. When we started, it was around 1.108. There's been a really healthy, gradual growth, and from this type of assets, I don't expect those spikes in valuation increases. And again, that's looking at the exits that we've achieved and seeing exits happening at premium to carrying value. That also translates into gradually growing NTA.
And of course, the dividend.
And the dividend growth,
out.
yes.
So
the dividend goes out of NTA.
Yeah. Thank you.
You're welcome.
Any more questions on WMA? Yep, over there.
Good morning. I'm not sure whether this question is pertinent, but I'll ask it anyhow, about alternative assets. Do you consider like electric cars alternative assets, and do you have any investment in materials for construction of electric cars or electric anything? And yeah, that's the question.
Yeah.
And probably how do you play?
Yeah.
Can you play that thematic? Is that what you're looking for?
Yeah. So that's energy transition. I think Anna talked about the energy transition during the roadshow. So we do see definitely increase in demand for electric cars from the alternative assets perspective. So for me, alternative assets, they're the ones that are backed by assets, and that's why, something like hedge funds, this wouldn't be included in WMA. So in order to play energy transition theme, and if I see the increasing demand for electric cars, I would look in areas like infrastructure, where there are opportunities to invest in battery storage, renewable energy, any innovation within private equity space in terms of improving battery efficiencies and how to produce them in a more cost-effective way. So within infrastructure, we started getting some exposure to battery storage, not directly to electric cars. And I feel like that space is probably still at that phase where a lot of innovation is to happen over the next 12 to 18 months. And it's still unclear whether this market segment would be more successful in terms of the investing via listed, i.e. equity market, or via more private space. But I'd say it's around infrastructure and around innovation that we can look at within those thematics. I hope it helps.
Yeah, but is there any exposure
not directly to electric cars, but battery storage, yes, we do have exposure to infrastructure.
Oh, okay. Storage. Gotcha. Would that be much of the portfolio?
No, not much, no.
1% or 2 or less?
It's about 1%.
Okay. Great. Oh, yes?
Sorry to hog the mic. Always have questions. Let's say, I'm not sure if Plug Power or Charge Fox are private. Their infrastructure, their charging networks around Australia. And one, would you be interested in that kind of infrastructure? And number two, what's your process for saying, oh, look at this little private company over there. I think we want to approach them and I think we want to invest in them. How do you go about that process?
Thank you. Great questions. Look, there are some examples of privately owned companies and the ones who own electric car. Do you own an electric car?
Personally, I didn't drive here with an electric car. But unfortunately, the car I drove, I do own an electric car, my wife does. The car I drove in here said, I've got problems with my oil.
Okay.
Which I'm thinking, I probably wouldn't have that with my electric car. So I'm a bit pissed off.
Okay, well, my question was...
I've got to find a good mechanic if anyone is a mechanic. Yeah.
Where do you charge, right? Because there are still a lot of different providers of charging stations. So one of quite successful privately owned businesses called Jolt, they provide charging stations around Australia. And a few years ago, they had BlackRock approaching them and saying, we do want to help you grow, and BlackRock invested $300 million to help them expand the business. So we'll see more and more of this type of businesses growing and expanding. Caution needs to be exercised, however, because from my perspective, regulatory changes will still be happening within that space. So it's still very unclear to what extent the government will influence this sector and this industry. And I love looking at assessing at risks. That's back to your question, how I do due diligence. Because those are long-term, illiquid investments in businesses, understanding the risks and understanding what are the instruments or tools to manage those risks. If we invest in those assets today, we're likely to hold them for 5, 7, 10 years. And so regulatory risk is one of the key ones that's very, very hard to manage and really hard to predict which direction it will go. While those opportunities exist, I'm very cautious around this type of opportunities for WMA at the moment. In terms of the due diligence, higher level, I'm usually breaking down into what I call 6 success factors. So it's assessing the business itself, the sustainability of the business, how profitable it is, would it remain profitable for the next 2 to 3, 5 years. So it's a lot of more technical analysis on the financial performance of the business, structure of the business. Very interesting due diligence goes into people, because at the end of the day, we are in people's business. So understanding who are the people within the investment team, within the operational team, what is their experience and track record, also doing references. You'd find some really interesting stories during the process when you do references.
And mark my words, Dania does very deep references. Only because we were looking at potentially employing someone. And I said, Dania, do that? And she sent me a big essay about what they did here, why they left there.
So it's very important, right? Because good people, you want to have them in the business for a long time, and you want them to be committed. And at the same time, you don't want to be for 10 years with someone who doesn't have good reputation in the market. And then a big piece of the due diligence goes into investment strategy, portfolio construction, and opportunity set. Opportunity set assessment, I would draw parallel with Anna and her team. So it's a lot about looking at macro and analysis of the economic environment, financial markets. I absolutely love listening to their analysis and when Matt gives update to the team, because it's a lot of really good information on interest rates, inflation, etc. This is very important for us. And we produce, I would say, like on average, it's about 200, 250 hours that goes into due diligence on one deal. So in terms of the investment pace, it's quite a different pace, investing in 3 to 4 deals per year rather than in 50 to 100 deals per year. So a lot of work goes into this, and that would include also going and visiting assets. So yesterday when we were in Gold Coast, I went to see, we have investment in Gold Coast Transit, Rapid Transit. That's the light rail that they're developing there. And we were just staying close to the section that they're completing soon. And I know the 5 light rail vehicles, they just arrived there. And that should be close to completion when you read in the report, but I went to see, is it actually close to the completion? So a lot of work goes into this type of the assessment, and we have the investment committee, and actually Jeff is on the investment committee, that would then provide me with some tough questions, more like devil's advocate type of questions before I make the investment decision.
Just on the point of EVs and charging, in terms of that, like within WAM Microcap and WAM Capital, like we're obviously allowed to take pre-IPO investments where it's got a timeline to public markets, typically within sort of 12 to 18 months. So we actually have met a number of players in that space. Jolt's one that we've met recently that's potentially looking at going down the path of IPO, and obviously we have the benefit that we don't have to necessarily be invested for 5 years. So yeah, we've got the more optionality around liquidity and sort of seeing those businesses typically at a more mature stage as well. But it is a theme that we're very interested in.
Thank you. There's another question there. Thanks.
Dania, do you look at opportunities outside the Australian market, maybe New Zealand or elsewhere?
Not actively at the moment. When we started managing the portfolio, we had about 15% exposure outside Australia, and that included New Zealand, included Southeast Asia, and the US. So in the US, most of the larger assets we exited over that period of time. I expect there will be situations when we opportunistically invest, but we would only invest with our investment partners who have presence on the ground. Again, with this type of assets, given also the availability of the information, you really need to know who are the people managing and seeing the assets. It's very important to have presence on the ground when you make this type of the investments. So I don't rule out investments outside Australia, but the focus is on the Australian market predominantly. And in my opinion, it's a good time to focus on domestic market. I still feel, despite all the sentiment about the economy and the financial markets, Australia will be more resilient compared to other markets like the US, Europe, and Asia. And I think from the risk-return perspective, we'll see better opportunities here, at least over the short to medium term.
Okay, any last questions before we just go to FutureGen? Half an hour with FutureGen, then lunch. I'm getting hungry. I don't know. I had breakfast. I had a good breakfast too. But
thank you.
Look, thank you very much, Danielle, on behalf of everyone here. Thank you. Okay, sorry, Zoe Black and Gabriel Radminski. My guests on the panel today. Actually, why don't I just start off with Future Generation, just to give you the logic. Broadly, back in a number of years ago, I was in the UK and I saw this guy had set up a listed company, and he'd organised all the fund managers to manage the money for free, and then which allowed him to give money away to charity. And it was mainly the Institute of Cancer Research he was focused on over there, Tom Henderson. And I just thought, what an incredible structure. And so I came back to Australia, and the logic was, hey, let's get the smartest fund managers in Australia to manage money for free. And then, so therefore, money can, they can not get paid their fees, and effectively allowed 1% of those assets to go to charity. And to me, the interesting thing is, when I was ringing the fund managers, well, first of all, the great thing is, because of Paul Keating and the structure of superannuation in Australia, has probably has created a lot of wealth, well, for a lot of people in terms of franking credits, etc., but also for a lot of fund managers. And I'd ring the fund managers and I'd say, look, well, let's say, well, if I rang you, Gabriel, because we were in the same building, so I saw you on the left. But when I was ringing the fund managers, I'd ring them and say, hey, look, Jeff Wilson, I'm just ringing because I want to put my hand in your pocket. and then of course, and then they take a step back, and it was, what I'd like you to do is. And then they're thinking, oh, this is going to be bad. How much is it going to cost me potentially? And then I'd say, look, could you manage some money for free? And then there's sort of a sigh of relief. And because we're the fund manager, say you're managing, say $1 billion. If you manage another $100 million for free, all it means when you're buying, a position in a company, you've got to buy 10% more. So it's not as if, it's not like a, someone that, an accountant or someone that works in a shop. Where you get paid for your time, where a fund manager gets paid by the assets they manage. So by managing some money for free, it wasn't that bad for the fund managers. And what surprised me was how easy relatively it was to get the best fund managers in Australia to manage money pro bono. Of the ones I asked, I think only one said no. And that was more because he sort of claimed he had some conflict because he managed some other money for another charity. So Gabriel is one of those fund managers, and on behalf of the FutureGen shareholders, and just with that, there's two listed companies. One has fund manager FGX, which invests, all the fund managers invest in the Australian market, and the other one is FGG, where all the fund managers invest in global markets. And Gabriel's one of our fund managers that manages the money in the Australian market. But before we get to that, I think I'll go to Zoe first. So therefore you've got the fund managers managing money for free. And since we started, about $75 million has gone to charities. Because of the two funds, they're about $1.1 billion. And the fees that, if you just given your money to the various fund managers and asked them to manage the money for free, it would have been, about $130 million you would have paid. So shareholders of the two entities have basically got a benefit of $55 million. So not only the charities get a benefit, but the shareholders got a benefit. And the fund manager gets the benefit because he understands he's doing the right thing. so that's why it works, and it works well. But on the important part, Zoe, and Zoe is one of our for-purpose partners, and one of our for-purpose partners in the mental health space. That's FGX, which is Australian shares, and that's focused on children at risk and supporting children at risk. And FGG is global shares, and the money for that goes to support children, mental health of young people and children. And the funny thing is, this is the funny thing, is Zoe and 2014 you started your business. 2015-16 there was someone rang me and hit me up. He said, "Oh, do you want to put some money? We're going to put this award to help some charity that that's in its early days." And so Wilson Asset Management, not shareholders, Wilson Asset Management put some money in. And Zoe was a winner. And then when the FutureGen team went to look for charities that could help children and young people with mental health issues, I specifically was not involved at all. And I saw you on the list. I saw you on the list when there was 180 on the list, and I saw you on the list at the end. And congratulations! I was very pleased that you were successful. And well, I've never told you, but you probably thought I influenced the decision. I had no influence whatsoever. So Zoe, do you want to explain what you do and why the guys? Because FGG in the early days it was giving its money to the big charities that do all the work on mental health. And then now it's really focused on prevention. And Zoe, do you want to just talk about that a little bit?
Yeah, for sure. So the organisation I run is called Happy Paws, Happy Hearts. And as you can tell, it would have something to do with animals. You can see me with a dog there. When people think about animal therapy, they immediately think about training animals that get matched to people, guide dogs, seeing eye dogs, etc. And the approach that we took almost 10 years ago now was to turn that around, flip it around. We knew there were lots of rescue animals sitting in shelters that needed extra hands-on time and attention throughout the week. And we thought if we could reach out to the community and find people who were otherwise socially isolated and bring them into those shelters to work with those rescue animals, they would get a benefit and the animals would get a benefit. So the young people that we work with, they are matched to groups with other young people, they're set up in training rooms, they do programs, they're learning about the animals. And by stealth, we help them learn about themselves as well. And the animals have gone through trauma, being rescue animals, and a lot of the young people we work with have experienced significant trauma in their life. But this can be, I guess, the starting point for them to take a new journey, feel a sense of purpose and a positive attitude about themselves. A lot of the young people we see, because of their mental health challenge, have dropped out of school, have lost a lot of confidence in their ability to learn, and we know they are capable of learning, but because they didn't navigate school around their mental health diagnosis and then retreated, it means that actually the animals are just a beautiful way for them to know that they can learn, because as they're learning things through our programs, they're teaching the animals and the animals are demonstrating it real time to them. So it's sort of a win-win-win, because the animals benefit obviously from the touch time and the training, and the young people benefit because they're in there making friends, learning new things, and we can get them back to school, we can get them onto employment pathways. And, you know, I think overall the community wins because they're involved in a big, you know, community effort to tackle both of those challenges at the same time.
And Zoe, you're a local girl, well, sort of localish, Brisbane.
Yes.
That's sort of local. Well, I don't know, is it local?
I love Noosa.
Yeah. being a Melbourne boy originally, but then living in Sydney and now spending a lot of time up here, I'm not sure where. And so you started there, and where are you now, and how many people, and give us a little bit of how it's grown. And
yeah, absolutely. So it started with just myself and volunteers. So I went out to...
And just with yourself, what's your background?
Oh, I did a combination of things. I worked in not-for-profit space with deaf and hard of hearing and communication impaired, and did big technology trials to change that landscape in Australia. And before that, I was in construction and mining and metals, and went all over the world. And believe it or not, those construction skills, and they come into play in what I'm doing now, because I have to do a lot of building projects at shelters to run our services. So it's weird how the patchwork came together. But yes, we started in Brisbane. So we started at that. If you haven't seen it, it's an incredible animal care campus that they have through the RSPCA in Brisbane. We call it the Disneyland of animal care campuses. It's colourful. It's got a beautiful
Whereabouts is it?
In Wacol. It's actually built within the old youth detention centre. So,
right.
And the offices still very much look like prison cells. But it had perfect infrastructure for building for the animals, right? It had a lot of concrete and a lot of drainage and things like that. So it was a sensible kind of space to build this mega animal campus that holds hundreds of animals, and it also works with about 40 to 50,000 wildlife go through their hospital as well. So it's huge numbers of animals going around that campus, always very much reliant on volunteers. And so I started there. You know, I knocked on the university's door and said, can I have some psych students and social work students? And they said, oh, you won't have any problems. They're going to be working with animals. They'll be there. And started that way and proved the model. And then decided to sort of start taking it into other locations. So now we run what I say from top to tail, so from Darwin down to Hobart. So we've got, you know, Mackay, we've got North Brisbane. We would love to come to Noosa, and that is on the plans. We're just waiting to see what happens with your local shelter here, but there's a few others that have been in touch too. And then we, you know, go down into Hobart, Hunter region, Toowoomba. So yeah, we've expanded, and now I run a team of, I think it's up to 47 trainers and enrolment coordinators and things like that to locate, and we have over 500 people coming through programs every week.
And you know the frustrating thing is, when I knew you were going to be on here, I thought, you beauty, we're going to have some puppies. But
the venue
wouldn't let us. So next time we'll find a venue. Only because when we had you in Brisbane, God, they were cute, weren't they? We all got our pictures with the puppies. Okay, so that's pretty exciting.
It is.
It's pretty exciting. Yeah. Okay.
And the partnership here, I mean, that's why we had that confidence to go into Darwin and go into Hobart and keep scaling our impact, because we do a lot of measurement and evaluation to check that the programs are working, and FGG certainly. I knew you weren't involved in the selection process, so I had to...
It was very scientific.
Well, the due diligence was incredible. I think it was more than 250 hours out of Emily to check that we were delivering the impact that we say that we deliver. So we have a lot of measurement and evaluation. I'm not just in the business of running programs for programs' sake and watching the activities, even though they do give you a lot of joy to watch the activities. activities, I wanted to know that this was really having an impact for the young people coming through programs. Are they growing in confidence? Are they, you know, accessing new social networks? Is their communication improving? You know, what's going on with their mental health, and whether or not they were going to get into a position to pathway either back to school or into employment. You know, I met this one young girl in Brisbane, and when she came in, she did not say a word in her first kind of enrolment, you know, session to come into programs. Not a word. Her mum was so worried she just would not leave the house, and the only social interaction she had, and she would have been about 16 at the time, was mum's family daycare, you know, and the little kids in the family daycare, and that's not enough for a young woman. And she had a bright future ahead of her, I felt, but she just was so socially anxious that she couldn't kind of, you know, engage, and she was knocked back from a volunteer role at the shelter because she had all these additional needs, and they knew that she'd needed a lot of confidence building. So she came to our programs, and she's really flourished. She's made friends. She'll approach you in the cafe. She's, you know, running her own business in animal photography, and much to mum's delight, because she never thought this was possible, she's gone back to school to finish high school because she now understands like what she wants to do with her life.
Oh, fantastic. That's great. And in terms of measuring, so what's the data points, or like, because Gabriel and myself, you know, we like to understand what the numbers tell us.
Yeah, so we tried a number of tools, and so we looked at things that you would expect a university would suggest that we try, like health-related quality of life surveys, and even post-traumatic stress disorder kind of instruments. And we found that to be quite invasive for the participants, because they come to us to have a different experience. They're there because they want to work with the animals and they want to meet people, and they don't want to go back into that medical kind of interrogation that they had to even get the diagnosis, and some of them have multiple diagnoses in the first place. So we tested and failed with a few different instruments, and then we found a tool out of the UK called the Outcome Star, which has, our star has 9 points on it, and it's about all these different aspects of their life. But the way that we capture that measure is to, the trainer will have a conversation with that young person, or they'll walk a dog with that young person and ask them about all of these points, and they can, you know, plot that, and then that gives the young person a visual of where they were, and as we, you know, plot it every 6 months, how they're tracking. And it's a really interesting tool, because sometimes they'll start really closed in, so at, you know, 1s, and we want to get them out to a, you know, a 10, but they sometimes will go out, and then we'll, I guess, challenge them, you know, go and try an employment traineeship, and they'll come back in, and you can see, you know, their growth as we push and, you know, trying to get them to, you know, leave our coop pretty much. But it's not an invasive experience for them. It's a conversation that they're having with a trainer that they know, and that they can then, you know, reflect on how they're going. And for those that are still working on some of their literacy as well, which is for some of our participants, it gives them at least the visual of how they're tracking.
Oh, brilliant. Look, thank you, Zoe, and thanks for all your work you're doing on behalf of everyone. So that's the good part. The well, no.
What a setup.
Well, no. When we're like, when, you know, both FGX and FGG, the two fifth generation entities I was talking about, they both have boards and they both have investment committees. And the reason why they exist, well, is a dual purpose. Is a dual purpose, and you're part of the purpose. The other part is, and the reason, you know, they'll continue to grow and prosper, is because we've been able to get access to the smartest minds, investing money in Australia and globally.
And then there's me.
No, and that's you. That's where you come in, Gabriel. From my perspective, the reason why I'm a big shareholder in FGX and FGG is because I want it to perform. I think it's incredible that the performance, one of the outcomes of the performance can be to support what you're doing and the various other charities. But, I think all as shareholders, we want the FGX and FGG to perform. Like FGX at the moment is trading at about a little under a 10% discount, and FGG is a bigger discount. It's about a 17% discount. We're very confident. Carolyn Gurney, who's the CEO, I'm doing the Noosa chapter. She did Toowoomba 2 days ago and the Gold Coast yesterday. I'm very confident we will get it, or Carolyn and her team working with us, we will get it to trade at NTA, if not a premium. So that's where you're important, Gabriel. And first of all, thank you for persisting, because Gabriel was coming up from Sydney this morning and there was an accident in one of the tunnels, so he missed the plane. So he literally arrived a couple of seconds ago. Thank you for persisting. So you manage some of the money for FGX. An overriding comment for both FGX and FGG, because we're investing with managers we believe, have outperformed over time, boutique managers that can make a difference, not the more staid traditional guys, because the boutique guys have their own money in the funds. We tend to have a skew to more medium-sized and smaller companies, because that's where you can get the real performance. And the interesting thing is, on one of our earlier panels, that sector's it's been pretty tough from an investment perspective. But Gabriel, how you invest and where you sit in the portfolio, you're in the, you can dial up your cash levels if you want. So you're sort of a more defensive strategy in the FGX, but also you buy positions in companies, and then you sort of get a hammer. Well, actually, no, maybe. Oh yeah, okay, maybe it's not a hammer. Maybe you just get something small and whack them on the toe. I was going to say, or whack them on the head. So, I think you're called an activist in the investment game, aren't you?
Yeah, we're not, sort of daubing paint on the front door of companies or defacing artworks or anything like that. Probably the best way of thinking about it, we're just...
Oh, and also, and you manage a pool of capital for us, yep, which is in an unlisted fund, yep, that you've got,
yep,
but also you have an LIC,
correct,
which is trading at a discount, yep, to NTA, yep, which is SNC, and I'll declare my interest. I'm a big shareholder because I believe in what you do. Please, sorry, Gabriel.
So look, we're a value investor. I think across the board in FGX, there's probably a bit of a value bent. Yeah. We've got people who like buying, $1 for 80 cents or less, or 50 cents if, if the market allows it. The difference with us is that what we try and do is, an activist has loaded connotations, but at the end of the day, all we're trying to do is exercise our rights as shareholders to ensure that companies, boards and management look after us. What we always start off as is very private, quiet interactions with the companies, and we sort of say, hey, this is what we think. Have you thought of this? Have you thought of that? We're trying to sort of change the status quo. But what often happens, particularly with the less good companies or the ones who've got more problems, they tend to go, no, not interested, we know best. What we then do is we pivot and we go and speak to other shareholders, other fund managers, and we articulate a case, and we simply try and start a contest of ideas to see what idea is the best. We often find that our idea does come up trumps, but it's literally a process of going out and trying to persuade people. We've got one going on at the moment, which was a little bit awkward. I did give Caroline...
Who's that? Are we allowed to talk about it? Sorry.
Yeah. No, I was just laying the groundwork. I did give Jeff and Caroline a call to let them know before we went public, but it was with one of the FGG managers, Magellan. So we've taken a small position in Magellan Financial Group, which has had a really tough run of late. And in June of this year, we went public after having tried to engage with them privately and articulated 5 things that we thought they should do. That campaign.
Hey, was one of them chop the CEO?
We didn't say that. We did not say that publicly.
Sorry, which anyone who's read the paper, they have. Yeah, sorry.
Look, again, we never take any pleasure in someone losing a job. It's it's a difficult situation, but sometimes at the end of the day, people at that level of responsibility are, some would argue, paid danger money. They're well looked after. I don't think too many hearts need to bleed when you're paid $1.8 million a year.
Yeah, and you've got to perform.
Yeah. So that's what we do. We invest across all sorts of sectors, and we try and take a responsible, thoughtful approach to the engagements we make. We're trying to find solutions that are to the benefit of all shareholders, not just ourselves. Our stakeholders are typically other fund managers, including some of the fund managers that are on the FGX roster. You know, we've often had conversations simply as a shareholder ringing, for example, Oscar and the team at WAM Capital to say, hey, here's a company, here's what we think. You know, other fund managers like Regal, Perpetual. At the end of the day, it's about sharing ideas and trying to push a particular way of doing things that is different from what the company wants to do.
And maybe after you've given that explanation, I was thinking maybe you should be called a liberator. Not an activist, hey? I better Google what that.
Yeah, no, you're about to sort of launch into the Gordon Gekko quote.
No.
Wall Street, where he says, "I'm a liberator of capital."
Oh yeah, that's right. Oh, maybe.
That's why I don't use that
word. Maybe it's in the back of my mind from there.
Very subconscious.
Okay, and maybe we'll drill in a bit more about that, but just try to set the scene for us. You know, it's a pretty tough. We're all a bit worried about what's happening in the market. Here we go. When do you think the bottom? This is a question I asked the other panel. Oh, and actually, I probably should.
I'll tell you with absolute certainty
that you'll be wrong.
About a year after it happens.
Oh, no, that's exactly. No, that's good. You could actually nearly tell me 9 months, I'd say, but maybe not absolute certainty.
In 2020, when COVID was unfurling and disaster was all around, we decided we had to write to our investors to just, you know, hold their hands, tell them what we were doing. At the end of the day, we didn't know what was going to happen, but we simply thought, well, by telling them what we're doing, maybe that will help allay some of the anxiety that was out there. And I think we put the letter out on the 23rd or 24th of March, which was almost the bottom of the market. But that was just complete serendipity. We had no idea.
That was a Tuesday.
Yeah.
Yeah, very good.
Past performance is no predictor of future returns.
Okay, so in terms of what's your view of the market, or I won't pin you on what month or day the market's going to bottom, or has it bottomed?
I think so. Look, we don't sort of invest on the basis of getting the big things right. We're investing in individual companies, but we're not ignorant of what's happening in the wider world. And put it this way, let me make an observation. The plane was full. The flight I finally got onto was full.
And you know what? You're the one you missed.
Yep.
I bet they gave you a seat. Someone bought that seat.
Probably.
It was probably full too. Yeah.
The traffic coming here. I've never been to Noosa, so it's my first time.
Yeah,
first time.
Welcome,
very busy.
Welcome to Gabriel. Welcome.
Thank you.
Welcome. You'll never leave.
It's the traffic.
It's called Hotel California, Noosa. So
the traffic is, there are people everywhere. And the observation I'd make is...
it's the triathlon this weekend.
Maybe so, but the observation I'd make is that everyone who... If you read the newspaper headlines or read the evening news, you'd think the world was about to end. And I'm not talking about all the tragedies that are happening overseas. But our economy, things are actually ambling along.
So you think another interest rate increase?
Possibly, I don't know. Again, I'll tell you after the Melbourne Cup. But I think the way we look at it is that life goes on. You can't sit back waiting for exactly pin perfect precision to say, I'm going to do this with the market. We, for example, in COVID, the way we construct our portfolios is quite long term. When COVID struck, we didn't know what was going to happen. Reality is no one did. Some people were lucky because they said, oh, well, we cashed out. When in doubt, sell out. That's fine for some people. We didn't. But then when the COVID recovery came, our portfolio went through the roof. We didn't change anything. We were joking internally that our recovery portfolio was the portfolio we established back in sort of 2017. We didn't know. We were just holding on to the companies that we thought could do well. So again, everyone's circumstances are different, but I think a lot of the financial press, you know, what sells newspapers and TV ads is bad news, and people forget that there's a lot of good news out there. I think if you have a mortgage, I've got a mortgage. I mean, God, the cost of my cost of living is through the roof. You know, health fund, private school fees, mortgages, insurance. If you're renting,
and groceries, Daniel, in the previous panel, you know, groceries are up 60% this year. $775, did she say, was the average?
But only a third of Australians have a mortgage.
Oh, I was going to say only a third of Australians buy groceries.
No.
I was going to say, what are the other? So, yeah, only a third have a mortgage.
Only a third have a mortgage. So, you know, we've got some most of our portfolio is exposed to what we call the industrial economy.
Do you want to give us some
So
ideas?
companies that, for example, provide services to infrastructure, the resources sector.
But can you tell us a few names of the companies?
So our two largest, depending on the day in the share price, are two companies, one called Fleetwood Australia, or Fleetwood Limited. The other is called COG Financial Services. Fleetwood is Australia's largest modular builder. They used to make caravans. Someone called out caravans. Yep. Yeah. No, it's okay. Yeah. We hear you. Everything you say, we hear. They used to make caravans badly. Part of our campaign was to get them to get rid of all of those businesses. So today, the bulk of what they do is Australia's largest modular builder. They do emergency accommodation, mining accommodation, retirement living, schools, prisons, not as palatable, but anyway. And they also have some accommodation villages in Western Australia. There's a...
Do you still like it?
Oh, look, we're the largest shareholder.
Yes.
That's how much we like it.
Well, you could be the largest shareholder because you can't get out.
No, we put it this way. We put as chairman someone whom we have an enormous amount of confidence.
Yes.
A fellow called John Klepek. I think John's mettle was probably tested in a combination of being a senior executive of BHP and then running Hancock Prospecting for Gina Reinhardt.
Oh, okay.
Who's a local, I believe.
Sometimes she's up here. Has anyone ever seen Gina up here? Oh, there we go.
Well, we installed
Spend
John.
more time up here.
We organised to have John installed as chairman, and that led to the old chairman being kicked out, the managing director being fired, new managing director appointed. So we're very heavily invested in what has happened because we had a hand in it, but we also believe that the industry has a lot of opportunities, you know, dealing with, you know, the government's putting in a program of building a fleet of emergency housing units that can just be, you know, taken to where they need to be taken to. Now, Fleetwood will be one of several, but as the largest builder, we think they've got opportunity. COG Financial is building and has built the largest network in Australia of finance brokers. So small and medium-sized business broking. If you have a small business and you need to finance some new trucks for your transport business, you're likely, you know, 1 in 5 people will call a COG broker to help arrange that finance. So that's building a business in the industrial economy. And the insights we get from both those companies are quite useful for us because they're dealing with the real economy. They're not dealing with newspaper headlines or TV segments or even fund managers. They're dealing with real people. So we get a good insight of what's happening out there. And yes, some sectors are doing it tough. Residential construction, you know, things that are subject to consumer discretionary. But all these other sectors are just booming. You know, you can't, you know, even today, trucking companies need to wait months to get a delivery of a new truck. Electric vehicles are booming. They have a novated leasing business. In Karratha, there's a village called Searipple that's owned by Fleetwood. And Karratha today is undergoing probably, and time will tell, we'll know this in a couple of years' time, but it may be a boom that exceeds the previous resources boom. You've got huge projects.
We should have bought some houses when they busted a while back.
Yep. Well, apparently every day there are at least a dozen people who get off flights, workers who get off flights in Karratha who have not booked accommodation and are literally like, you know, like the old Bible stories, knocking on the door looking for a place to stay. The building boom is Woodside with its oil and gas offshore projects, BHP, Rio. There's green projects, hydrogen, renewable energy hubs. It's possible that Karratha in a few years' time becomes the largest renewable energy hub in the world with the number of projects that are being built out there. And Searipple is one of, there are several others, but Searipple is one of those villages that will house all the workers. So when we look at that, Share price doesn't reflect any of this because people are looking for data points, I think, in the short term. But from a medium-term outlook, we're very relaxed about the quality and the prospects of those businesses.
What price is it trading at the moment?
Fleetwood. So Fleetwood in the last month and a half has gone from $2.14 down to $1.65 or thereabouts.
Oh, okay.
Just because people are impatient.
Yeah.
And again, I think...
And it's a small cap and...
It's a small cap.
Maybe big seller.
And you know this from, you know, your portfolios. A lot of the time what's happening is a contest between investors' time horizons. People might like a company, but someone for some reason, you know, it could be they've got redemptions, they have to sell. Pushes the share price down. Someone else has got money coming in, or they have to buy. And in the meantime, the company keeps operating. You know, one of the pieces of advice, and it came up at the AGM for Fleetwood the other day where John was telling the story that sometimes the CEO and the management team worry about the share price, and he just keeps telling them, forget the share price will take care of itself, run the business. Yeah. And as an investor, that's sometimes the challenge is when you're assessing the quality of a business, sometimes the share price is telling you something different, but you've got to focus on what you know. So we try and focus on, and we do focus on what we see coming from companies. Fleetwood, for example, $2.14 down to $1.65. There's been nothing in terms of news that would suggest that decline is warranted.
And it is interesting, just talking to the boys back in the office, you know, they were saying that, and this is whether it's a bell, you know, this is ringing the bell for small and mid caps. One of the big industry funds, the boss came and said, I don't want you, by the end of, you know, the month, I don't want you to own one, you know, small cap stock in the portfolio. Because, you know, people tend to, they capitulate at the wrong time.
Well, what's also happening, and, you know, Phil King, when he presented to the investment committee a few months back, talked about small caps, you've talked about it, and we see it. As people have moved to the perceived safety of either cash, which is eroding your money because of inflation, or they go to large cap stocks, huge amounts of money have gone and bid up the prices of very large companies, we think to the point where some of them aren't worth it. But that means that when the sentiment changes, the whiplash in small caps is likely to be quite strong.
That way.
Well, yeah, we've already had whiplash.
We don't want a bad whiplash, good whiplash.
Good whiplash. Good risk.
Look, thank you, Gabriel. And why don't I open it up for any questions for Zoe or Gabriel? Any questions? Yeah. Thank you.
Zoe, I was just thinking, post the voice referendum, Jacinta Price would really appreciate some help from you with the Aboriginal kids who have been badly affected.
Yes, I think so. And Darwin has been like a new area for us to enter into, and we're getting a lot of calls from different community groups. We're finding in Darwin that I think because programs have gone in and out, they sort of want you to be there for a while before they trust that you're actually going to stay in the area. But we're starting to see, you know, exactly that, young people. We also see young people, you know, just generally in out-of-home care and kinship care, high proportion of Indigenous young people in those systems at the moment. And so we do see some of those participants in our programs if they've got an organisation that can connect them in. But, you know, it's incredible what animals can teach us and, you know, how much just joy can be sparked in just that short amount of time. So we got some feedback from one of our youth groups the other day, and these are kids that are in last chance school, alternative schooling in Brisbane. And the worker that was with them said, it was just nice to see these teenagers just be teenagers. You know, they've got so many other worries going on for them, and for them to have this space to just be teenagers and to have that, you know, those moments of joy with the animals, because the animals will always do something to make us giggle, have a laugh, or something, you know, quirky. And, you know, that always fills my cup to know that we can even just do that for a few hours a week can be the starting point to something much bigger.
Thank you. Any other questions for? I'd be disappointed if I expect at least 3 from you.
I could go 3, but Gabriel, all these strong personality investment managers strikes me like a barrel of monkeys making investment decisions. So I don't know how you get all these people to agree what you're going to spend the money on. But what is the character of FGX in terms of their investment strategy? When you all guys all get to your decision, what's the main strategy for FGX investment-wise?
Can I throw that one to Jeff?
So FGX, broadly the strategy for FGX is to give shareholders the market return, if not better than that, with less volatility. So the investment committees pick, there's a 14 or so, say FGX, the Australian one, 14 or so managers, and a combination of managers that are just like 100% invested in the market. Some can hold cash, can be a bit more defensive, and then we also have another group, that's sort of a market neutral managers. So that will be long and short. So it's really a combination of the three, and FGG has similar groups of managers.
So you but have people partitioned off?
Correct. Yeah. And if you look at the, go to the website, look at you'll see what percentage are in long the market. The other one, the ones that can dial up the cash, we call them absolute bias. So what is the most cash you've had, Gabriel, in your fund? Since you've been managing it under
Gosh, I mean, at one point we're at 70.
Yeah.
At the moment we're at negligible levels.
Yeah. So in theory, Gabriel, for FGX, what percent? Do you know what? Do you own about 5.5%? About 5.5% of the FGX portfolio, Gabriel manages, and he's in that more absolute. More. What am I saying? He's not in the absolute. He's in the. What's the other category? What did I just say?
I was still thinking about barrel of monkeys.
Yeah, anyway, you knocked us all off with that barrel of monkeys. Yeah, I'm with the barrel of monkeys. I thought, where's he going with the barrel of monkeys? He's in the absolute bias. Yeah, one. So, so that's right, he's just got a bit more flexibility.
But I think on the barrel, because I'm obsessing about the barrel of monkeys, I think it would be a barrel of monkeys.
Well, only because you're trying to shoot one at the moment.
But the FGX is invested in a series of individual funds. So I manage, FGX is invested in our fund, and we manage that back at the office, and we report to FGX.
And it's in the main fund. Yeah. Not the listed one.
No,
in the main
our wholesale fund.
He started with.
Because I do think if it was one pool of money where we all had to manage the money together, it would be a barrel of monkeys.
It would be. Yeah. How would you get any result? Broadly, so FGX or FGG starts off with $100, and the investment committee, and we've got experts in the industry, asset consultants, the best you can get on their investment committee, and they say, look, let's put 20% in sort of absolute bias or X amount in market neutral, X amount in long equities, and then who do we put in that? We'll put 4% or 5% with Gabriel. We'll put so much with this other manager. Yeah, so the individual managers don't communicate with each other, and what we do is we go in their main fund. So because we want to be in the fund that they've got their money in. So that's pretty much how it's done. Thank you. And we had a question here. Thank you. Yeah.
In choosing who you're going to select as your beneficiaries, are any of those charities funded from a public purse?
Yeah, that's a really good question. And so is the government funding for any of the charities or the for-purpose entities that we support, are any of them supported by the government as well? Are you guys supported by the government?
Well, I guess if you consider that we have participants that use their disability funding, then you would say yes. But they have choice and control.
But do you try to get are you trying to get supported by the government?
Sometimes if there's a grant that comes up, so for example, when we went into Darwin, the federal government released a grant about, taking good programs out more regionally, and it made sense for us to apply for that grant, but we're not funded as like an advocacy body for any, no stable government, this is what you're going to get for forever and a day kind of funding, no.
But the answer is yes. The only, when we, and I'm just not sure, when we recut the charities for FGG, for the mental health ones, we went away from the Black Dog, the Beyond Blues, the sort of the ones you'd expect, the big ones, because we thought, let's try to go down, let's go to the prevention area, and there was charities that didn't have turnover of more than $15 million, I think, or $16 million. That was one of the thresholds. So we were sort of consciously trying to go for the smaller ones. But some of them may have, we'd need, I know Emily Emily or Carolyn, they would be able to answer it immediately. I'm more on the investment side. So, I don't know. But I know there would be some that I'm sure are government. They do get some government money. Yes. Thanks.
I listened in to your conference last week on philanthropy. Just wondering if you had any change of thoughts yourself, or that you'd apply with the future generations going forward. Are there some things that have come out of there that you perhaps hadn't thought of before?
Yeah, no, that's very good. There was a future generation a seminar, a conference, and it was great. Just having various people present. There was a few panels with fund managers, and the Sydney Morning Herald and its associates really embraced it. They interviewed the people, and I had the pleasure of interviewing Dan Pallotta, who is quite, well, he's an activist, but he's an activist in the charity space, and just trying to retrain your brain in terms of what you should do. And one of the messages that he was giving is that charities should be run as if they were corporate organisations. And they should be, just like Tesla might lose money for X amount of years and spend so much money gaining market share. So you as a CEO of the charity, you should be doing that. And people that give the money to the charity shouldn't be saying, no, we want this to be for that program. They should be giving it to you and saying, we want it for you to spend on marketing to significantly increase your business. And then I know, I assume you're the question. Well, the answer is there hasn't been a board meeting for either of the entities, but it's something we're going to have to discuss in quite a bit of detail because I think it's sort of embedded in us, and this is what Pallotta talks about. For some reason, even though I know the logic, if I donated money to you, then I want to know what it's going to be used for. And if you told me it's going to be used for administration or marketing, I'd say, tell me what program it's going to be used for. For some reason, it's inbuilt in us. Anyway, so now the answer is we haven't had time to. There hasn't been board meetings to discuss it. Do you think, what are your thoughts about what we should do or what we could do? Could you, I just grabbed the...
Yeah, I think your previous comments sort of encouraged me that you're targeting a sort of smaller group, a smaller turnover there. So, yeah, I think we're already on the right path. But it's interesting,
just being a bit more flexible. How do we cause these charities to grow in their influence? And it might not necessarily be putting more frontline people on there, but it might be increasing their effectiveness and their reach and drawing other people into partners. So I think it's well on the path, and I'm not particularly looking at throw everything up and reinvent what you're doing. I think it's evolving well already.
Yeah, and I think you're right, and I think that's why we changed with FGG more focus to find people that we think can make significantly more impact.
Well, sorry, and I'm on the FGX side and I'm on the investment side, as Jeff said, but just listening to the questions and the answers, I think what's happened, one way of looking at it is that the problems that exist have been long-standing across all the different areas. Yes. And the largest charities are the ones who've been trying to solve and address the issues for the longest, and giving money to perhaps newer, smaller ones who might be doing it differently. Yeah. You know, if you keep trying to solve the problem, if you keep trying to solve the same problem the same way, it's not working. Maybe you just need to do it differently.
Yeah, and I think Dan Pallotta said in his question, in the Q&A, he said, when a charity was ringing up to say, hey, look, I want you to come along and celebrate, to celebrate our 50 years. And that's what he was saying. Are you serious? Yeah, what have you been doing for the last 49? You should, unfortunately it hasn't worked somehow. Sorry, yeah.
Perhaps one last comment in your own language. Boutique charities, instead of the big ones, just as you're using boutique investment houses. Yes. Perhaps that focusing on the boutique charities and those that are upcoming and those that are innovative and light on their feet is perhaps the most effective way.
No, very smart, and that's probably it's a good way of categorising it, because with FGG that is, and with FGX that was the logic, and try to find people that that we made a difference to, and probably part of it is from the Pallotta's comments is make sure that when we communicate with the charities is, we want to support you to significantly grow, for you to significantly grow, and whatever resources you need for that, we're here to support that. We're not here to...
You heard that right.
Hey, I'm on the investment side. But I think that's what the outcome will be.
I mean, and I think that is actually
correct.
Your model from my perspective. It's really hard to find supporters like we've got in FGG. They're not directing us, you have to do this program, you have to add that program, you have to do this, and then you have to acquit back that you did this, this, and this. They looked at us in a lot of detail. They came out and saw our work in progress. They went through all the measurement and evaluation, and then they said, we're going to fund you to keep doing what you're doing, but we trust you as an organisation because we've done our due diligence on you to keep, scaling your impact. And that was it. And the other part of it is bringing all of us boutique charities, as you call it, I really like that, together to talk about how our collective voices could be brought forward to explain why prevention in mental health needs a focus, because in Australia we've typically put into reactive, centres, walk-in centres, etc., reactive phone lines, rather than prevention and trying to change the course of a young person's life so that we're not constantly in this reactive mode. So both of those two things, suggest that you're on the right track from what I heard.
No, thank you, Zoe. And how are we going for time? I know I could be a little bit over. Oh, whoops. Am I 35 minutes over? Oh. I knew I had a timeline earlier, and I was hungry earlier, and I'm hungrier now. And I hope you all are. Look, on behalf of everyone here, look, thank you, Zoe, for the work you're doing, and thank you, Gabriel, for the work you're doing. Yeah. And Gabriel, thank you for persisting. See, to me, very impressive when Gabriel, when he made it here. See, that's his determination, and you want to back people like that. So, no, thank you very much, guys.
Thank you. Thanks, Jeff. Thank you, everyone.